In our previous videos, we've covered the basics of investing with small amounts, understanding the stock market, and getting started with low-cost index funds. Today, we're diving deeper into another important investment vehicle: mutual funds. Mutual funds allow investors to pool their money together to invest in a portfolio of many different stocks, bonds, or other securities. This provides instant diversification and professional management for a low cost. While index funds track market indexes passively, mutual funds are actively managed by professional fund managers. Selecting the right mutual funds is crucial for building an efficient, balanced portfolio. But with thousands of funds to choose from, it can feel overwhelming. In this video, I'll discuss why mutual fund selection is important, provide a framework for analyzing funds, and recommend some specific fund options to consider. By the end, you'll feel confident evaluating funds on your own. Let's start with why mutual fund selection matters. The fund you choose will have a major impact on your long-term returns, costs, and risk level. Actively managed funds have higher fees than index funds, so you want to make sure any added costs are justified by potential outperformance. You also want to align the fund's investment objective and holdings with your personal goals, timeline, and risk tolerance. A well-selected fund portfolio provides broad market exposure at low cost, while avoiding underperforming or overly expensive options. This maximizes your chances of achieving your financial objectives. Taking the time up front to analyze funds sets the foundation for long-term investment success. Now, let's explore how to analyze and select mutual funds for your portfolio. Step 1. Define your investment goals. Start by defining your investment goals. Are you looking for long-term growth, income, or a balance of both? Understanding your objectives will guide your fund selection. Step 2. Assess your risk tolerance. Consider your risk tolerance. Different mutual funds come with varying levels of risk. Make sure the funds you choose align with your comfort level. Step 3. Research fund performance. Research the historical performance of potential funds. Look for consistency and how they've performed in different market conditions. Step 4. Understand fees and expenses. Be aware of fees and expenses associated with each fund. This includes management fees, expense ratios, and any other costs that may impact your returns. Step 5. Check fund manager experience. Explore the experience and track record of the fund manager. A seasoned and successful manager can contribute to the overall performance of the fund. Step 6. Diversify across asset classes. Opt for funds that provide exposure to different asset classes. This diversification can enhance stability and mitigate the impact of poor-performing investments. Step 7. Regularly review and rebalance. Once your portfolio is set, regularly review its performance and rebalance if necessary. Market conditions and your financial goals may evolve over time. Now let's discuss the key factors to analyze when evaluating a mutual fund. Investment objective. This tells you what the fund is trying to accomplish: income, capital appreciation, growth, etc. Make sure its goals match your own. Watch out for vague objectives that don't provide clarity. Expense ratio. This is the annual percentage of your assets the fund charges you to manage the portfolio. It's deducted from returns. Lower is better, with 0.1–0.5% ideal for active funds. Index funds can be under 0.1%. Manager tenure. You want a manager with a long, successful track record at that specific fund. 5+ years shows they've proven themselves through market cycles. High turnover can mean the previous manager underperformed. Performance. Look at returns over various periods, the 5th of March 10 years, compared to the fund's category average and benchmark index. Consistent outperformance, especially after fees, is a good sign. Style ensures the fund aligns with your desired allocation across investment styles like growth, value, large, small caps. Blending styles provides diversification. Holdings. Reviewing top 10-25 holdings lets you understand if they match the stated objective. For example, a large cap fund should hold primarily large companies. Minimum investment. Consider your initial investment amount and ability to add more. Higher minimums can limit access for new investors. Turnover rate. The percentage of portfolio holdings replaced in a year. Higher turnover means more trading costs draining returns. Under 30% is preferable as it indicates a buy and hold approach. Evaluating funds across these criteria helps identify well-run options that fit your goals at a reasonable price. But how do you actually research funds? The best free resource is Morningstar.com. Here you can search thousands of funds, compare statistics, read analyst reports, and see charts of historical returns. I also like Fidelity, Vanguard, and Schwab fund screens. Just be sure to compare fees. Once you've identified a few potential candidates, it's time to select specific funds to build your portfolio. Here are some fund categories to consider. Total Stock Market Index Fund. Immediate diversification at ultra-low cost. S&P 500 Index Fund tracks the 500 largest publicly traded companies in the U.S. Total International Stock Market Index. Global market exposure beyond just the U.S. Total Bond Market Index. Diversified bond holdings for more conservative allocation. Right Index Fund. Real estate investment trusts provide income potential. Target Date Retirement Fund. Set it and forget it option that adjusts risk for you. When selecting specific funds, I recommend sticking to the largest, lowest cost options from Vanguard, Fidelity, or Schwab. Some fund options to consider in each category include Total Stock Market, VTI, FSKAX, SWTSX, S&P 500, VU, FXAIX, SWPPX, Total International, VXUS, FTIHX, FTIGX, Total Bond, BND, FXNAX, SWLBX, Right, VNQ, FSRNX, SWISX, Target Date, VTTSX, FDKLX, SWYJX. A well-diversified portfolio would hold one fund from each category to provide broad market exposure at minimal cost. Rebalance annually to maintain your desired asset allocation as values change. Once you've selected your funds, here are the steps to get invested. 1. Open a brokerage account. Fidelity, Schwab, Vanguard recommended. 2. Transfer money from your bank. 3. Place a market order to buy your chosen funds. 4. Set up automatic monthly investments. 5. Monitor your balances periodically. 6. Rebalance annually as needed. Following this process keeps it simple while ensuring you have efficient, low-cost exposure to global markets. Remember, focus on your long-term goals, not short-term fluctuations. Stick to your plan and trust the power of compound returns over time. Congratulations! You're now equipped with the knowledge to analyze and select mutual funds for your portfolio. Remember, the key is to align your investments with your goals and risk tolerance. If you found this video helpful, don't forget to like, share, and subscribe for more financial insights. Stay tuned for our next video. Until then, stay financially savvy.